Welcome to PhillipCapital Experts Talk. My name is Sam from Unit Trust Research Department. Today, we are honored to have Dr. Bill Maldonado, who is a HSBC Global Asset Management's Chief Investment Officer of Asia Pacific region and a Strategy Chief Investment Officer for equities globally. Based in Hong Kong, Dr. Maldonado oversees the investment strategies in the region. He has worked in the asset management industry since joining HSBC in 1993 as a European derivative-based portfolio manager. Over the past 18 years, Dr. Maldonado has headed up a number of investment functions, leading him to the current job role. Dr. Maldonado holds a PhD in laser physics from Oxford University and an MBA from the Cranfield School of Management. And today, he will be providing us some expert inside views on investment prospects within the Asia Pacific region. Thank you, Dr. Maldonado, for taking out time for this interview.
Thank you.
Let's get started with the questions. In late second quarter, we saw heavy concerns over China's credit crunch and the big shadow banking system. Now, some compared China to the US in 2007, while others cited Japan before the 1989 real estate bust. But things seem to have changed and turned around now. Having fallen on hard time in second quarter, China's economy rebounded in third quarter as data streaming out from China reflected an economy that is beginning to recover and reaccelerate once again, and as World Bank still maintaining China's growth prospect at 7.5%. Do you believe that the new regime's structural reforms are the reason for this change?
Well, I think that's a great question. I don't think we've seen too much in the way of structural reforms so far. We've seen some piecemeal reform. I don't think it's right to compare China to the US in 2007. There's some very important differences. The main one is that the Chinese government, the authorities, have always demanded that the loan to deposit, the loan to value ratio for a property be relatively low. So it's been very hard to borrow money in China unless you have a loan to value of 60%, 50%, something like that. That simple measure has done a huge amount to protect China from a really nasty real estate bubble. If that same measure had been in place in the United States or the UK or Spain, that would have helped tremendously. We're not out of the woods yet, though. There is a lot of concern, quite rightly, about the shadow banking system in China, and that's yet to be resolved. We don't think that it's a black pit for losses, which a lot of people believe. I think if you make that assumption, you're really saying that the assets backing up a lot of these wealth management products are worthless. And I don't think that's right. I think many of these assets are good assets and very productive assets. But nevertheless, there's been an awful lot of issuance of these types of products. The government has tried to clamp down on that, but there's still a big book out there. So there's still a lot of resolution to take place. There's still a lot of figuring out if there are losses in the system. Who's going to take the losses? Is this going to be the local government, the banks, the central government? How's that going to be borne? So we're really looking forward to seeing how the government deals with these very important issues in the coming 6 months or so.
Okay. Are we actually through with the problems such as credit crunch and shadow banking crisis? Or is it still looming in the backdrop?
I don't think we're through it. I think the shadow banking crisis is less of a concern. But in terms of a credit crunch, I'd actually sort of turn the question around the other way a little bit and say, really the big concern in China is that it's become such a credit-intensive economy. In order to fuel GDP growth, the economy needs more and more credit pumped into it. And that situation is not sustainable. That's going to require a restructuring of the economy, much greater efficiencies in the economy, a liberalization of the interest rate regime, and many changes, none of which are particularly easy for the Chinese government to bring about. So we're definitely not through it, but I don't think you're going to see a hard landing in China. I don't think we're going to see a big reduction in the size of the economy, not for the foreseeable future.
Okay. We all saw a massive rally in stocks since Shinzo Abe stepped up as a Prime Minister of Japan. His Abenomics, which included a hefty amount of stimulus among other things, did generate quite an interest in investors. Last week we saw measures taken for fiscal consolidation by Abe with a sales tax hike to cut the nation's towering debt ahead of any risk to recent economic growth. And at the same time, promising some more stimulus to cushion the impact of sales tax increase. How do you feel that the investment community should be reacting to it?
Well, I'm afraid that we wouldn't be nearly so positive about Japan. I think that Abe's policies so far have achieved a weakening of the yen that does seem to be sustained, and that's positive for exporters in the economy. It's also led to a small increase in inflation. So for the first time in a long time, inflation is positive. However, not for the right reasons, if you ask me. The reasons why inflation is running at about 0.8% positive is that Japan is having to import most of its fuel needs today, having shut down its nuclear reactors around the country. And with a weak yen, those fuel imports are costing more money. And that's what's fueling inflation. Now, that is not good for the economy. That's not beneficial to the economy. What Abe wants to achieve, what's required, is for the consumer to come alive and for companies to come alive, to hire more people, to undertake more capital expenditure, to be more active in the economy, individuals and companies alike. And that really hasn't happened. And the third arrow, so-called, of the Abenomics policy framework is the most important one. And that third arrow is about structural reforms in the Japanese economy to make the economy more flexible, to make it less rigid, to, for instance, allow easier hiring and firing of workers, to require less licenses for different trades. And there's no signs of those difficult reforms happening. Abe himself said so in an interview in the FT the other day, where he conceded that these reforms were going to be very difficult and he wasn't sure how they were going to achieve them. So I'm afraid so far it's a little bit smoke and mirrors, and we haven't seen anything that's really of benefit to the investor. So we're very skeptical, I'm afraid, about the situation at the moment in the Japanese economy and the Japanese stock market.
Are these measures, including tightening in fiscal policies, mixed with loose, unconventional monetary policies, sustainable? And is Japan moving in the right direction?
I think Japan is moving in the right direction, but only if they implement the third arrow, only if there is structural reform. If they don't, all this will be a wasted effort, and the yen will strengthen again, and inflation will go negative again, and we'll be back to where we started. The rest of the policies, for instance, the hike in sales tax and concerns about the mountain of debt that Japan has, really nothing has been done on those. The sales tax is a very, very marginal adjustment. And in a way, that's also a big worry, because if Abenomics does succeed, if we're wrong, for example, and I'd really love it in a way if we were wrong, if the Japanese economy actually did get back on its feet and the changes took place, there's another problem waiting further down the road, and that is that with debt at over 200% of GDP, if inflation really does go up, bond yields are going to start going up. And servicing that mountain of debt for the government at 0.5 to 1% yields is doable. At 2, 3, 4% yields, it's impossible. So there's another trap waiting down the road, and it's not at all clear how they get out of that one. So big problems for Japan, not just now, but in the future.
We all know that the Fed's move in May after giving some signal for tapering spurred a rally in stocks and currencies in BRIC nations, especially India and Indonesia, where officials had to take steps including raising of interest rates to stem an outflow of capital. We also saw that the stock rebounded back in September after Fed decided to continue their bond buying program. Now, these countries are actually facing some fundamental issues, such as India with a challenge of opening more industries to foreign investment, Indonesia with domestic infrastructure weaknesses, and Russia with a persistent budget deficit, not to mention the growth rate decline on a gradual basis. The Fed at some point of time will have to start cutting its bond buying program. Do you believe that we might see some more ferocious sell-off and capital outflow in BRIC nations in the coming quarter? Or maybe early next year again?
The short answer to that is no. I don't think we'll see that. I think the market's reaction so far to the announcement that a taper would begin at some point has been a massive overreaction. In reality, these nations and all growth nations, emerging market nations, face a mixture of weak global demand and domestic issues. In the case of Indonesia, a big current account deficit and a weakening currency. In the case of India, a total lack of action by the government on infrastructure projects, and again a weakening currency. These domestic and growth issues, global economic growth issues, are much, much more important than anything the Fed says about tapering. We're talking about a drop in the ocean. When the Fed talks about removing $5 billion per month of quantitative easing, that really is of no consequence to India or Indonesia's ability to finance their current account deficit. So actually what they should hope for, what all investors should hope for, is that we get a rapid recovery in the United States and in other developed economies, and that the Fed has good reason, good solid economic reasons to remove stimulus, perhaps more quickly than we all anticipate today. That should be very good news for developing nations, because that will mean that they'll see demand going up for the commodities they export or the goods they manufacture or services that they provide. And that's much more important for their economies, that's much better for their economies in the long run than any tapering, any quantitative easing that the Fed might be able to provide. So I hope, as we see the recovery really setting in globally, that this paradox in the market, this strange reaction that the market has to good news being bad news, goes away, and we go back to thinking about growth being good for equities, because at the end of the day, that's the only thing that's sustainable.
How comfortable are you in investing in BRIC nations on a long-term basis?
Extremely comfortable. All of my savings are in BRIC nations, or let's say global emerging markets, for the long run, because there's a big rebalancing of the world going on in that direction. Much more trade is being done between emerging market nations. That's where the growth is. That's where the population demographics is beneficial to investment and to the economies. Sadly, for developed markets, for Western nations, all of those things are headwinds in their cases. Very difficult to see how they're going to reverse those headwinds and benefit from an aging population and very mature economies in general. So the growth, the future is in emerging markets, and that's where I want to be invested. That's where, as a firm, we want to be invested as well.
How do you rate the investment prospect of investment in Asia compared to more developed markets, especially to the likes of a more opportunistic Europe?
Well, look, I think that as long-term, medium to long-term play, Asia should be a core holding in people's portfolios. I don't really see how people can avoid that exposure. It's almost a necessary feature of the portfolio. And there's a very, very good case for that. Growth rates are great. Corporates are very profitable. They're not very leveraged. Trade, as we said earlier, is improving, increasing all the time. There's great reasons to be invested in Asia today, tomorrow, and for the long run. From time to time, of course, in our palette of investment opportunities, things arise. Dislocations create opportunities. And certainly Europe got sold off to a far greater degree than it should have. People got too bearish about the prospects in Europe. Effectively, they were pricing in a breakup of the euro, which never looked likely and looks extremely unlikely today. And that means, yes, tactically speaking, I think there are good opportunities there, and perhaps even longer term opportunities. But I would say for an Asian investor, as a part of their portfolio, Asia should be at the core, whereas Europe perhaps is more of a tactical play as opportunities arise.
Okay. Which sectors or countries are you weighing heavily on for a mid to long-term time horizon?
Well, where we see the best combination of value and profitability probably is in Asia, out of all the global emerging markets in the world and out of the developed markets. And within Asia, North Asia is the cheapest and most profitable part of Asia. So we really like Korea, we really like China, we like Hong Kong, we like Taiwan, basically the northern Asian markets, because they've been out of favor, because people have been so worried about the impact of a slowdown on China, on those economies, they've sold off, not on fundamentals, not on what's really happening to corporates, not even what's really happening in those economies, but on some concerns, unjustified as it turns out, about what China might do. So now that it's obvious that China is not going to tip into a recession or a hard landing, or even much of a decline in its growth rate, those markets look great value. And within those markets, the sectors that look really interesting are the cyclical sectors, those economically exposed sectors. So energy, materials, consumer durables, and financials. And the sectors that look really overvalued are the defensive sectors, like healthcare, like consumer staples. And the disparity in those valuations at the moment is huge. We've never seen a situation like we have today, where you might have to pay, on average in the region, 3 or 4 times price to book for a defensive stock versus 1.5 to 2 times price to book for a cyclical stock. That's a huge disparity, and that anomaly has to be reversed. It can't be sustained like that.
Thank you, Dr. Maldonado, for your time.
Thank you.
Thanks. That's all for now. For more information on unit trust investments, you can also visit us at www.eunittrust.com.sg.